Hey everyone, welcome back to the channel, your number one source for income-oriented investing, how to generate passive income from a diversified portfolio of high-yield funds. And speaking of high-yield funds, the leveraged ones, we got a bunch of them in Canada, none yet in the US. But in today's video, I'm going to tell you or give you the 5 reasons why I absolutely love leveraged covered call ETFs. And then I'm also going to talk about the risks as well. And then we'll do some comparisons at the end. So this is a question I've been getting often, guys, more or less worded in a different way. What are the actual risks of owning or additional risks of owning a leveraged covered call ETF, or one that's leveraged versus the non-leveraged one, right? So in Canada, we have a lot of leveraged covered call ETFs. Most of them are, 99% of them are leveraged 25%, except for BMAX, that's 33%. But what is the comparison, or what is the risk compared to the non-leveraged fund, if that exists, right? A lot of them it does. For example, Harvest, right? You got HHL and you have HHLE. You have HDIF, that's the leveraged one, and then you have HRIF, the non-leveraged. Horizons, pretty much all their leveraged ETFs are just hold 125% exposure to their non-leveraged ETF. So, there's BKCL and then there's BKCC, the non-leveraged one, et cetera, et cetera, et cetera. So I'm going to give you the 5 reasons why I absolutely love the leverage versions, why I would always choose, if I had an option, the leverage version instead of the non-leverage version. And then we'll talk a little bit about the risks as well. I know you're interested and some of you were worried about that. And then we'll actually do some comparisons and some hard data, because for some of these ETFs, it's been over a year that they're out, and we could actually compare them to the non-leveraged version. So let's check it out together right now. All right, so reason number 1, guys, is of course, no brainer, more yield, right? More passive income. If you're adding a little bit of leverage to something, you are obviously going to have more yield if it's an income product, and more growth if it's a growth product. Well, the growth part is more over time, right? And we'll talk about the risk a little later. But as an income investor, we're going to stick to income here. The leveraged income products, you're going to get more yield. Now, is it 25% more yield? Not exactly, because there's leverage costs, remember. But I would say it's approximately anywhere between 18 to 22% more yield, something like that. Maybe less, maybe more. Really depends, because again, there's leverage costs. Is very important. They're borrowing that money. You got to pay the leverage cost, and that's based on the interest rate, the current interest rates, which is fairly high right now. So just because it's 25% leverage isn't necessarily you're going to get 25% more yield, but you're definitely going to get more yield. That is definitely reason number 1. And I have to say my favorite reason. Reason number 2, that it's really a small amount, 25% leverage, which is the most common leverage amount. Just BMAX uses slightly more, 33%, but BMAX has 30% of it is fixed income. So I would say that just nullifies the risk right there. So let's just say 25%, guys. Normally, it's a very small amount. That is basically like taking a $250,000 mortgage on a house that's worth $1 million. It's a very small amount. And another thing is that it's on quality stocks, quality indexes. Typically, right? It's on blue chip stocks or blue chip or indexes that have all the blue chip stocks. So that is reason number 2 why I love it. It's a very small amount on quality, which reduces both of these factors, make it not much more, or just a bit higher risk, right? Reason number 3 is that the leverage is managed by the professionals. It's not you taking leverage or borrowing money in your broker account. You don't have to worry about margin calls. You don't have to worry about getting crappy interest rate, because we're retail investors as well. So this is all included in the fund. You don't have to worry about any of that stuff. And the big fund managers that manage billions of dollars, they get much better rates, or the better rates compared to us. So that is the 3rd reason. So it's very hands-off, right? You could say it's hands-off. Hands-off leverage managed by the professionals. Reason number 4, and this is where we're going to talk about the risk. The risk is basically, essentially 25% more risk, aka 25% more volatility with the leveraged fund compared to the non-leveraged fund. And I say, my response to that is, so what? Who cares? Why am I saying that? Because I am a long-term investor. If you're going to buy and hold something long-term for 5, 10, 15, 20, 30, 50 years, you're going to have, during that time frame, the portfolio of stocks is going to be 25% more volatile, right? So if the market crashes and your fund, whatever the fund may be, goes down let's say 10%, the leverage version is going to go down 25% more. It's going to go down 12.5%. So of course, leverage works both ways. Yes, you get more yield and growth potential during rising markets. That's great. And even flat markets, it's fine because you're getting more yield and it's staying the same. But it also applies to the downside as well. That's why you always will have to say that there's more risk with the leverage ETFs. But what is the risk? I mean, the risk is really based on your strategy and your amount of time. If you're a long-term investor, I don't even see it as more risk, because if I'm going to hold an S&P 500 for 25 years versus holding it with, let's say, 25% leverage for 25 years, for me, the risk is zero, because I'd rather have the leverage version, because as you'll see in my next point, this is going to be point number five. It's for me, it's not much of a risk, right? Because I'm just holding it anyway. So if you have 25% more swings, more volatility, as a long-term investor, that shouldn't bother you, right? So if you're investing for 6 months or you have a short-term horizon, obviously the risk is much higher, because there's more of a possibility in that time frame that it goes down 10% and you'll go down 12.5%, right? Because it's 25% more downside. So for me, I don't care about this risk, but that is the risk. Why don't I care about it? Because I really don't give a crap about the price swings during the time I'm holding something long-term. It shouldn't matter to you if you are a long-term, keyword, long-term investor. This brings me to final point number 5, and then we'll view some examples which ties into this. Potential, I gotta say potential, but I will say pretty much in brackets, probable outperformance or better performance, right, compared to the non-leveraged version. Keyword, over the long term. Very important, over the long term, right? So why is that? Well, it's very easy to understand, guys, because the markets typically go over the long term, not short term, long term, go up more than they go down. So there's more, you get more return with you get an enhanced return. It's as simple as that. It's not rocket science. So there's very, very strong possibility that the longer time goes on, the leveraged one will outperform. Now, I personally don't think they're going to outperform 25%, because remember, it's 25% minus the leverage costs, right? That's why the leverage ETFs, you look at the MERs, they're so much higher than the non-leveraged ones. And maybe even the management fee could be higher, right? If you look at USCL versus USCC, for example, the management fee itself is actually a tad higher. ENCC versus ENCL, QQCC, QQCL. Some of them have even slightly higher management fees. Some of them don't, right? Some of them don't, but some of them do have slightly higher management fees. You got to watch out for that. Plus, there's the leverage cost. That's why the MERs are bigger. So it's not exactly, I don't think it's going to be 25% more. It's going to be 25% minus the leverage costs, which are high right now. But I think when interest rates go down or start getting cut, that will definitely help leverage funds, because the leverage costs go down as well, right? But the main reason I feel that over the long term, keyword long term, they're going to outperform is because markets go up over the long term more than they go down. So let's take a look at some examples now, because some of these leverage ones have been out for over a year, some of them 6 months, 4 months, but it's going to be very interesting to take a look at some that are doing better and some that are not doing better. And as usual, it's not rocket science to figure out why when we use this. Let's check them out. All right, guys, couple of examples that I've lined up for you. We're going to take a look at 1, 2, 3, 4, 5, 6, 7, 8 examples. And this is a nifty little website, by the way. You could always, I would bookmark it. It's great to compare two funds. CanadaStockChannel.com. So you go there and you just click on calculator, and you'll be able to input two symbols. You could compare two symbols together. You could even put the start date or whatever, but you know, if you just leave the start date to 1995, basically it will use the date when the later fund came out, right? So it can't compare two things if one of them hasn't existed yet. So you know what I'm trying to say. So the first one that we're going to compare is HDIF versus HRIF. So HDIF is Harvest all-in-one covered call ETF, which has multiple Harvest covered call ETFs in there, and it's leveraged 25%. HRIF, the exact same thing, same stocks, same everything without the 25% leverage. Let's check out the comparison. And the reason I chose this one is it's been around for more than a year, I believe. So let's see. Okay, it's since early 2023, so almost a year here. And you'll see, first of all, that it's very, very similar in terms of the graph, right? In terms of the graph, it's very, very similar. But surprisingly, you might be shocked by this, but I'm not. Right now, the non-leveraged version is actually outperforming very, very slightly. I'm sorry, I have no idea what I'm saying here. The leverage version, which is in black, is outperforming the non-leverage version. So here you have a fund that's pretty much identical. One has 25% leverage, the other one does not. And HDIF, the leverage ones, I apologize about that, is currently outperforming or doing better than HRIF. Is it 25% better? Well, total return is about 10%. It's about 20% better, something like that. So not exactly 25, but quite a bit better. And this is almost a year of data. So you see here that the leverage one is doing better, but you could clearly see when. That is another thing you guys need to understand. And it's very noticeable if you're looking at this graph here. Hopefully you could see it. It's big enough. I apologize if it isn't, but if you look during the upswings, the black one is the leverage one, the blue is the non-leverage. You clearly see that the leverage one is going up higher during the times where the market is going higher, but lower. You see here it's way lower than the blue when there's downside. So that's exactly what leverage will do. It will amplify the downside and amplify the upside as well. So if in the time frame there's more upside, there's a strong and probable chance, extremely probable, that it's going to outperform. So here's one where the leverage one is doing better. Let's look at another example, USCC versus USCL. So USCL has been around for, I think, not even 6 months or something like that. But let's do the comparison. And also USCL, the leverage version, is outperforming USCC very, very, very slightly. And this is a case, unlike HDIF and HRIF, where the management fee is zero, like there's no additional management fee. Here there is. So USCL has a management fee of 65 basis points. USCC is 39 basis points. So not only is it higher fee, my assumption is they're putting the higher fee for leverage handling. But obviously there's leverage costs as well. But USCL is still outperforming USCC. But it was not when the market was going down at this point here. You see that the blue, which is USCL, the leverage one, was lower. But now, over time, once the market goes up, you see even here was lower, but now it's started to catch up. I remember checking USCC versus USCL like 4 to 6 weeks ago, and USCC was doing better. So now USCL has overtaken it. It makes sense. The S&P 500 has been on a run. So if this continues, if the upside continues, obviously USCL is going to outperform. But remember, this is just performance, guys. The yield is always going to be a lot higher with USCL. So if you're an income investor, this is why it's the number one reason I put in the number one reason is more yield, right? Yield is more important as long-term income investors if you're living off the income for us specifically than total return. That's just how I feel about it. Maybe you don't feel about it, but if you're investing in a covered call ETF, the whole premise is giving up total return for yield, right? So I think the number one reason why you would buy a leveraged covered call ETF is not even for the outperformance, which you'll probably get slightly over time. It's for more yield. And we're talking about 11% yield versus 13% yield for this one approximately. And even the rest of them, the other one, you're typically going to get 2%, even more sometimes more yield. So USCL currently beating it. What about QQCC and QQCL? Right? Same thing, but NASDAQ 100. USCC, USCL was the S&P 500. Same type of story. The NASDAQ has been on fire. So, of course, QQCL is going to do better. And this is with a higher management fee and higher MER because of the leverage cost as well. But QQCC, 0.65% management fee. QQCL, 0.85. It's beating it. When is it beating it? When the market rockets. You'll see that that's when it'll really start making a difference. It's during the upside or a strong upside. So that's basically it. That's how it works. And you could see on the downside, here's a little downside. You'll see that QQCL, which is in blue, the leverage one is slightly lower, slightly performing worse. Of course, it's during a bad time, it's going to perform worse. Let's keep going with the examples, guys, because I want you to look at not only the diversified ones, but also some sector-specific stuff. HHL versus HHLE. Same management fee. There's no extra management fee. HHL is one of those funds that typically doesn't go up that much because it's boring defensive healthcare stocks. Let's do the comparison. And as you can see, it's not that much further, but HHLE is beating HHL. And HHLE, this is since the end of in October of 2022. So this is actually over a year of data here. So the total return, or let's say the average annual total return, 17.29% versus 15.02%. Of course, the start dates, it's always important when you're comparing total return, guys, to have the same start and end date. So in this case, the leveraged one is beating the non-leveraged one in terms of performance. So better performance, better yield. Now here's one where it's not. HUTL versus HUTE. So this is the Harvest Utilities Covered Call ETF. And you'll see that the non-leveraged one is actually doing better than the leveraged one. Why is that? It's not rocket science. Utilities have done in that period not that more crappy than they've done well. So you see a lot of downside. You'll see that the leveraged one is going to be lower than the non-leveraged one, of course. But it's getting closer, and I feel once utilities start picking up again, which is probably going to be when interest rates are getting cut, the leveraged one over time will probably overtake the non-leveraged one. So this is one where you could see it's not doing better, but that's because the sector has not done well in that time frame. CNCL versus CNCC, the overall Canadian market, TSX 60. Same type of story. The Canadian market has not had a great time, but CNCL, now it's starting to go back up and it's starting to catch up. You'll see that the difference there, the non-leveraged one, which is CNCC in blue, is doing better. It's outperforming, but just by 1%. And I think it's going to keep getting closer and closer as the Canadian market does well. So you want to do another one? Let's look at BKCL and BKCC. Big six Canadian banks, same type of story, I believe. Yes, same type of story because there's been a lot of downside. You'll see BKCL, the leverage one, in black. You'll see that the downside is more pronounced when they go down, but on the upside, it starts getting it starts closing the gap, the leverage one. So again, I think the same thing is going to happen over time. If the banks go up and up and up, eventually BKCL will take over or start beating BKCC. Last one, because I'm out of breath, ENCC versus ENCL, energy, right? So this energy as well has been doing good lately, but has not been, in terms of, if we look at the chart here, let's see, the leveraged one has recently taken over, or is the ENCL, the leveraged one, is doing slightly better than the non-leveraged one. That's because recently oil and gas has done pretty well. So I think you guys get the gist of it, right? So essentially, this is why I said I was very adamant about long term. I think that over the long term, because the markets go up more than they go down, the leveraged one will eventually beat the non-leveraged one. And the longer time goes, the more probably it will, unless there's a crash and maybe it'll reset. But I think over the long term, you got to think long term, it will. So and also when interest rates go down, that's also going to help the leveraged funds tremendously because leverage costs will go down. So they're even going to outperform even more. So in short, guys, this is my personal opinion. If you're a long-term income investor, I do not see any reason or argument why you would get the non-leveraged one versus the leveraged, unless you're investing for a shorter time frame or you really cannot handle a little bit more price swing and volatility while you wait. For me, it's extremely easy to handle it. I think if you're a long-term investor, it should be very easy to handle it. So I see no reason why. So I personally would always go with the leverage one. That's just my opinion. Nothing wrong with going with a non-leveraged one as well, especially when you see some management fee differences like on the Horizons one. And another thing to point out is don't expect 25% more total return, right? Because it's 25% more minus the leverage cost. So obviously if interest rates go down, the leverage costs go down, that will help it. I don't think it will ever be exactly 25% more. Maybe it'll be only 5% or 10%. Either way, I'll be happy with anything a little bit more. But the number one reason, in my opinion, I would always go with the leverage one because there's more yield. There's significantly more yield. Look at ENCC versus ENCL. We're talking like 3.5% more yield. Typically, you're looking at 2%, 2.5% more yield. It depends on the fund. But you do have to expect, guys, a little bit more volatility or 25% more volatility during the bad times. If you could take the heat, go with the leverage one. That's my take. Let me know what you think, guys. Do you prefer the non-leveraged ones instead of the leverage? Are you still not comfortable with the leverage? And if so, why? Let me know why. Again, remember those 5 reasons. This is managed professionally, no margin calls included in the fund. They get the best rates, very small amount of leverage, not a lot, on quality stuff. So those are my arguments. That's why I love leveraged covered call ETFs, and I would always take the leverage version if we have one. So with that, see you next time. Hey, don't go yet. A few reminders before you leave. Did you know that I launched a YouTube loyalty membership program where for only $3 a month, you could become a PII Inner Circle member, where you will gain access to exclusive content, exclusive videos and live streams, as well as other perks and benefits, including a really cool weekly opportunity report. That's right. If you're interested, just click on the little join button next to the subscribe button to see what it's all about. Also, make sure to follow me on Blossom and download Blossom. It's a social investing app, which is really cool. You could share your portfolio, follow other people's portfolios, including my own. My username is Adrian_PII. So download it with the referral link below. Not only is it free, but you could actually earn cash by taking these really small, quick 1-minute courses. Really awesome. It's a no-brainer. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could book a one-on-one private coaching session with yours truly, with myself, where you could ask me all the questions you want. All the information and booking information is on the website. Make sure to check out that video on the homepage there to see how to book a one-on-one properly. Also on my website, you could purchase my digital product, which I'm very proud of, the ultimate DIY investing package. This is a reference tool or a companion tool that will help you build your own portfolio. So it has lists of funds, it has sample portfolios, and it covers both the Canadian and US stock markets. And the good news is you'll only ever have to buy it once because it comes with free lifetime updates. And my plan is really to update the version every single year. So make sure to pick it up. Also, I have Questrade and Passive referral links below. So Questrade is the broker that I personally use, and Passive is the broker companion tool or companion or assistant that I use. Really cool program, really cool software. So I have referral links for both of those. Questrade, $50 of free trades. And Passive, I have half off for the elite membership. If you're interested in the elite membership, and even if you want to start out with the free membership and upgrade to the elite afterwards, use my referral code so you could still get that 50% off. And don't forget that the elite membership of Passive is 100% free if you use Questrade. For social media, we have a very successful and big Facebook group, private Facebook group with over 14,000 members, where we all try to help each other out. So make sure to join that group. Information is below. We also have Instagram, where you could follow us, or more personal stuff when it comes to our life here in Panama. And there's LinkedIn as well. So as usual, everyone, how do I leave you? Continue to stay safe, stay healthy, and of course, stay passive. See you next time.